Hello everyone, this is Madhvi Mehta from Kotak Securities Commodity Research Team and I'll be discussing the outlook for major non-agriculture commodities. Well, commodities fell for the fifth consecutive week, highlighting the inherent bearishness in the sector. Commodities fell as US dollar index continued to rise and set fresh highs. The strong correlation between commodities and the US dollar shows that demand supply factors have taken a backseat. Commodities witnessed another sell-off, but there were few highlights. Gold slumped to August 2021 lows. Silver tested fresh July 2020 lows, while crude oil slipped to February lows and copper fell below the 7,000 ton level for the first time since November 2020. Few of the outliers were lead and natural gas, which managed to end higher for the week. Meanwhile, the US dollar index rose for the third consecutive week and tested a fresh 2002 high. Another highlight was the euro, which slipped below parity levels against the US dollar for the first time since 2002. As trend in US dollar has been the key price determining factor for commodities in last few weeks, we can surely say that a recovery in commodities is difficult unless we see a sustained decline in the US dollar. Similar to commodities, equities have also been under pressure due to growth worries and tightening concerns, but we are seeing some attempts at stability. US DJI index ended lower for the week but well off the lows. European indices also ended lower but well off the lows. On other hand, Chinese equities ended lower for the second consecutive week and tested a 1-month low. If you look at the safe havens, we have a mixed bag. US Treasury bonds saw some buying interest, but other traditional safe havens like Japanese yen, Swiss franc, and gold continue to remain under pressure. The recent trend shows that the US dollar index has been the go-to asset in last few weeks as market players have shunned riskier assets in favor of the US currency amid increasing worries about health of global economy and expectations that Fed may lead other central banks in monetary tightening. The US currency got a fresh boost last week as US inflation data led to a fresh debate about pace of Fed's monetary tightening. US consumer prices rose 9.1% on the year in June, the fastest pace in 40 years, and well above market expectation of 8.8% growth. US PPI data also showed a bigger than expected 11.3% growth in producer prices. The inflation data highlighted that there are no signs of inflation peaking yet. This fueled debate if Fed could consider an even bigger move to get inflation under control. Fed has already fastened the pace of rate hikes from 0.25% in March to 0.5% in May and 0.75% in June. Post the recent inflation data, market players started debating the possibility of an unprecedented 1% hike at the upcoming meeting on July 26-27. The US dollar index hit fresh highs post-inflation data, but lost some momentum on Friday as market players paired expectation of a bigger move. Some Fed officials reaffirmed support for 75 basis point rate hike. This, along with a marginal dip in inflationary expectation, led to some profit taking in the US dollar. Along with firmness in US dollar, commodities are additionally pressurized by demand concerns amid downbeat growth outlook, mixed economic numbers and corporate earning results, and persistent virus concerns relating to China. China has been struggling to get virus spread under control, and its strict adherence to zero COVID policy has fueled concerns that restrictions may hamper economic activity. Amid the latest development, China on Saturday reported its highest number of coronavirus cases since May, and millions have been put under some form of restrictions. The country has continued to use mass testing, regional lockdowns to bring the virus spread under control, despite its negative impact on the economy. Meanwhile, mixed economic data highlighted the increasing stress on the economy. Chinese GDP rose at a much slower pace in second quarter, while industrial production rose less than forecast last month. Retail sales, however, unexpectedly rose last month. If you look at the trade data showed a sharp widening in the trade surplus as exports rose sharply. However, slower growth in imports highlighted weaker demand. While China has been the focus for virus spread, cases have been rising in other regions as well. The World Health Organization chief last week warned countries over new waves of COVID-19 and said the pandemic is nowhere near over. Meanwhile, growth concerns rose further as European Commission lowered growth forecast for this year and next. Outlook for European economies has also been clouded due to worsening energy crisis. Russian gas supply to the region has reduced amid maintenance. However, some countries like Germany are worried that Moscow may cut off the supply in retaliation to the sanctions imposed. The European Commission on Friday formally announced its proposal for a seventh package of sanctions against Russia, which may include the Russian gold imports, as well as EU is also looking at tightening the existing restrictions. However, some form of easing on Russian food and medicines are expected. Overall, commodities have been setting fresh lows, indicating bearishness in the sector. So the question is whether this trend may continue or we may see any recovery soon. A trend in US dollar is likely to remain the key price determining factor for commodities, with focus on economic data and monetary policy stance of central banks. There are little signs of correction in US dollar index yet. However, we could see increased volatility as market players position for central bank decisions and economic numbers. The key event in the coming week includes Bank of Japan and European Central Bank monetary policy decisions. Euro and Japanese yen are already at multi-year low against the US dollar, and central bank decisions may determine further trend. Bank of Japan is largely expected to maintain its support for loose monetary policy stance to boost support the economy. ECB is expected to start its rate hike cycle, and this has been factored in. However, there is still uncertainty if the central bank may make any aggressive move to control inflation. Other important economic events include manufacturing and services PMI data from major economies. Also in focus will be development relating to virus spread, especially in China, as well as development relating to Russia-Ukraine war. Let us now look at individual commodities, and we'll start with gold first. COMEX gold fell for the fifth consecutive week and tested the lowest level since April 2021. Gold fell to 11-month low amid persistent strength in US dollar, correction across commodities, and sharp ETF outflows. Gold has behaved more as a commodity lately than a safe haven or an inflation hedge, and this trend may continue in the near term with focus on US dollar and central banks. Gold may remain under pressure unless we see a substantial correction in the US dollar. The trading range we see for the week is 49,200 to 51,500. Moving to silver, silver has been one of the worst performing commodities due to the concurrent sell-off that we have seen in gold and industrial metals. Sharp ETF outflows also show that investors are exiting the metal. Silver has already slumped to July 2020 lows, and while some short covering moves are possible, the general bias may remain on the downside unless gold or industrial metals recover substantially. The trading range we see for the week is 54,000 to 57,800. Next, let's discuss industrial metals, starting with copper. LME copper prices fell below the 7,000 per ton level for the first time since November 2020 amid a stronger US dollar, rising bets of aggressive rate hikes coupled with concerns of serious global economic slowdown which weighed on the demand outlook. Also, mixed bag of economic data from China hinted that stimulus efforts have not been able to provide as much needed boost as expected. Copper prices made a strong recovery on Friday and closed near 7,200 levels on reduced bets of a 1% rate hike by Fed. Despite the recovery, we expect prices to remain under pressure amid worries that rising virus cases in China may result in further restrictions. Also, market players may keenly wait for manufacturing PMI data from major economies for earliest hints on factory activity in the month of July. The trading range we see for the week is 584 to 658. Next, let's talk about aluminium. Aluminium prices fell nearly 4% last week, hurt by macroeconomic weakness and increasing Chinese output amid demand concerns. The latest data shows that China's primary aluminium output rose 3.2% in June, with a year-to-date growth of about 0.7%. Meanwhile, Chinese exports have been 34% higher in the Jan-June period compared to last year. Going ahead, aluminium may remain under pressure as major demand driver, property market, is showing signs of weakness, with Chinese home sales having fallen for 11 consecutive months, marking the longest slump since 1990s. Also, aluminium output in China is expected to increase further as smelters in some regions are still resuming their production. The trading range for the week is 193 to 218. Moving to zinc, zinc prices slipped to 13-month low as lower steel output dented galvanizing demand. China's steel output has fallen 6.5% on the year in the first half of 2022. Highlighting bearishness in the market, LME COT report shows that speculators have reduced their bullish bets in zinc to the lowest level in more than 3 weeks. Zinc may continue to remain under pressure as China's steel industry is expected to see muted activity amid bad weather conditions, weaker profit margins, and higher inventory. Besides, investor focus has largely shifted to demand-side issues, overlooking supply disruptions from Europe amid ongoing energy crisis. The trading range we see for the week is 258 to 286. Lastly, let's discuss lead. Lead prices slipped to 20-month lows, hit by global risk-off sentiment and a stronger US dollar. However, prices made a sharp recovery and closed over 1% higher for the week on demand recovery in the lead acid battery market. Despite the positive close, we expect lead prices to remain under pressure as primary lead smelters in China gradually resume after maintenance. However, reduced production in secondary smelters in some regions due to power rationing may provide some cushion to prices. The trading range we see for the week is 162 to 178. Moving to energy complex, let's start with crude oil. NYMEX crude fell for the second consecutive week and tested the lowest level since February. Crude oil has erased almost all the gains noted since onset of the Russia-Ukraine war, as market focus has shifted from supply risk to demand concerns. Global growth worries and China's virus spread has dented demand outlook. Also weighing on prices, persistent strength in US dollar and weakness across equities. Supporting price are supply concerns amid increasing risk for Russian supply with no easy replacements. Amid the latest development, US and Saudi Arabia met late last week and agreed to work on ways to stabilize energy prices, but no concrete measures were announced. Crude may remain volatile as supply risks are countered by demand concerns. However, the general bias may be on the downside unless risk sentiment improves significantly. The trading range we see for the week is 7,050 to 8,150. Lastly, let's talk about natural gas. NYMEX natural gas rose for the second consecutive week and rescaled the $7 level. Natural gas has edged up, gaining support from robust cooling demand in US due to severe hot weather in some parts of the country. Also supporting prices firmness in European gas prices amid reduced supply from Russia. However, weighing on prices reduced exports due to temporary closure of an LNG terminal in Texas, which has diverted more supply towards domestic market and has led to bigger than expected buildup in gas stocks. Natural gas has rallied sharply in last few days, but we may see some correction soon amid improving US supply situation. The trading range we see for the week is 480 to 610. Well, that's it from my end. I wish you all a very happy trading week. Thank you.